The housing bubble is getting ready to pop, and that's going to cause massive layoffs in the mortgage industry, and it's going to ripple through the entire economy. We're going to talk about who's saying that. All right, now let's uncover this. Let's unfold this. So housing and real estate makes up roughly 20% of GDP in the US economy. That's huge. Now think about household debt. Household debt is about $16 trillion, and most of that debt is mortgage debt. Now, first, when the real estate bubble is being inflated, think about how that ripples through the economy in an inflationary way. So you see the mortgage brokers, the loan officers, the real estate agents, they're all getting a part of these mortgages, and the money that's issued through mortgages goes out to all these different people. They go out and spend it in the economy. That creates jobs because they're spending money now because of all these mortgages and the debt created. So more debt, more borrowing and spending equals jobs, creates jobs. But when the opposite happens, when mortgages drop and when mortgages are not issued as fast as they used to be, the opposite happens. So now we're going to see job losses, and it's going to start with people directly involved in the mortgage business, mortgage brokers, loan officers. They're going to be the people feeling the effect first, but that's going to ripple through the economy. It's going to go all the way to the furniture stores and all the places that people have to go to, the home remodeling centers, Home Depot, Lowe's, these home improvement stores. The ripple is going to be felt through the economy. But first, we're going to see it directly in the mortgage market. We've already talked about how loan officers are getting laid off and mortgage divisions are downsizing in different companies, different banks. All right, but let's take a look at a recent article here. And this is out of the National Association of Home Builders. The National Association of Home Builders. Housing's contribution to GDP. The total is between 15 and 18%. About 3 to 5% of that is residential investment, construction of new homes, remodeling, etc. But also consumption on housing services. That's another 12 to 13% of GDP, which includes rents, utilities paid by renters, as well as owners' imputed rents and utility payments. And it's not just new mortgage originations, it is also the refinancing. Take a look at this chart and see the enormity of all the refinances just in the past couple years. And let's go zoom in on this chart here. And here I am down in the bottom right hand corner. Hello. But look at this surge ever since the health crisis in early 2020. This is massive, and even more massive than what we saw. We did see some big spikes back in the early to mid 2000s and again in 2012 when mortgage rates dropped. But look at the enormity of this over the past 2 years, and look at the drop off that we've seen here recently with the concurring with the rise in the mortgage rates. And it's not just the refinancing. A lot of these were cash out refis. What happens on a cash out refi? Well, people get more money to spend in the economy with the cash out, and they go out and they buy things with it. Vacations, cars, and everything in between. Maybe a lot of those people you'll see at the amusement park, maybe they're spending money that they took out of their house through a cash out refi. And this was enormous. Cash out refis reached $1.2 trillion in 2021. That was the highest since 2005. All right, now imagine what type of ripple effect this is going to have throughout the economy. All right, trillions of dollars in money that was out there through all these loan originations and cash out refinances, as it was spent throughout the economy, created jobs. Now those jobs are about ready to vanish. So we're going to start seeing it in the mortgage division first, but the ripple out is going to go well beyond just the mortgage employees. Now there's some very interesting names out there saying that the housing bubble is popping as we speak, and that we're going to see price declines. And one of them is Wolf Richter. You might be familiar with Wolf Richter, wolfstreet.com. We show you the charts here, excellent charts. Recent interview, and we'll link to this. It's actually a YouTube video. And this was a very nice interview with Carrie there over at the Financial Survival Network, and Housing Bubble Getting Ready to Pop, Wolf Richter. So maybe go over there and give that a listen. And what's discussed over there underpins a lot of things we've been talking about here in this channel. Now, what does that mean when the housing bubble pops? Will lawmakers come in and just put a freeze on foreclosures? Will they try to keep it propped up by lowering interest rates and just knocking rates back down to zero? That's the thing. No one really knows what type of intervention and what type of hands-on approach that can be done by the powers that be. So just because a housing bubble pops doesn't mean prices are going to go down that far and that fast. I hope they would just let it go so we can actually see what real prices should be without all this debt creation, manipulation, kicking the can down the road, propping up of the markets. It would be nice to see what real prices should be without all of this just artificial stimulus, QE to infinity, etc. Now combine this ripple effect with the slowdown in the mortgage industry and refinancing and home purchases. Combine that with the drop in the stock market. Companies are laying off now even faster because of the big stock market decline. I won't call it a crash because some technical people would say, no, it's not a crash. It's got to be this amount of percent. It's a big decline in the stock market. A lot of people taking very big hits on their 401ks. Some people even saying that their 401ks are now 301ks because of the big decline. Now, the Wall Street Journal had a very nice write-up on this. The company's cutting staff, freezing hiring, and slashing costs amid a tight labor market. Public companies are starting to turn cautious amid falling markets. So yes, the stock market does have an impact on companies' view and outlook and positivity. So just to name a few here, looking down here, we've got Twitter. We know what's happening there, big shakeup. Carvana, Peloton. Peloton saw a huge collapse in their stock price. Netflix, Robinhood, Meta Platforms, Uber, Better.com, Wells Fargo, and on and on and on. So yes, it is beginning. It is starting. And the public, the typical consumer, has turned very, very negative on the economy. The world's a mess, so they've stopped saving for tomorrow. People just stop saving. They see prices going up. They say they're just going to go ahead and do what they're going to do. People are even worried that they're even going to survive this. So a lot of people are having the attitude, I might as well spend money now, I might as well have fun now, because this may not even be survivable. This is a real article. They stopped saving for tomorrow. From this article, in a tumultuous time, many adults under 35 have stopped playing it safe. Instead of banking as much of their pay as possible, as they used to, they're saving less, spending more, and pursuing passion projects and risky careers. So bottom line is, a lot of people are just giving up, and they see nothing but storm clouds ahead. Let me know what you think down in the comments. Wolf, with this prediction on the housing bubble popping, will it happen? Will prices fall? Or will the powers that be just come in with a bunch of intervention and cut rates again to keep prices from falling? The question gets more interesting as we continue here. So thanks everybody for being here. See you this weekend, hopefully with another report. Bye everybody. Peace.